Hi guys, can you all hear me?
Yes, sir.
Okay, so it's going to be a bit of a long haul flight today. We will have back-to-back sessions, and by the way, did we cover liquidity management? That's where we spoke about things like stable funds, vulnerable funds, hot money, and all that. Would you all remember that? That was about, if at all, maybe 2-3 months ago, which is a long time. And I know that all of you are suffering from short-term memory loss. So you may have forgotten. Because if we haven't covered it, maybe I might need an additional hour, perhaps sometime tomorrow, to finish that off. Would any of you all remember? We calculated net liquidity position. Perhaps I could not cover that. Right? So let's see how it goes. Yeah, so last week we covered futures, forwards, and swaps. The whole sessions. Right, for now, let's manage with what we have. Yeah, so last week we were on to derivatives, right? We covered forwards, futures, options, not options, but swaps. 3 types of derivatives. And today, let us move on with options, like option contracts. So before that, this is like putting the cart before the horse. So last week was like putting the cart before the horse. Before defining options, we went on to, before defining derivatives, we moved on to some of the products, right? So let's look at derivatives today. Derivatives are instruments whose value depends or is derived from the value of another asset, right? So these are instruments, according to Warren Buffett, I think I mentioned last week also, these are financial weapons of mass destruction. Okay. Now, the closest example I can give is if you take something like the BMI or the body mass index. That is the height divided by square of weight or something like that, or maybe the other way around, right? So using your height and your weight, I think it's weight divided by height square. Using your height and weight, right? Using your height and weight, you can see whether you are physically fit or not, right? Whether you're healthy or not, using two different measures. Okay, so the combination or the ratio of your weight and the height squared gives you an indication of whether you're obese. So if it's, I think if it's more than 25, you're obese, or if it's less than 20, you're malnourished. Right. So your body mass index should be somewhere in between. Otherwise, you're not in balance. Yeah. Right. So it gives an indication of your health, but you're using it two different indicators: your height and the weight. Whether the height corresponds to the weight, and whether the weight corresponds to the height. If it's out of proportion, it means there's something wrong, and you need to take corrective action. Either you should increase your weight or you should reduce your weight, depending on whether you're overweight or underweight. Clear? So derivative is an instrument. Its value depends on, is derived from the value of other assets such as stocks, currencies, interest rates, and commodities. Right. The main types of derivatives, well, in fact, derivatives can be structured out of anything. I think I mentioned last week also that derivatives can be structured even out of things like the weather, right? Or you have things like, well, actually derivatives were originally structured based on agri-produce, right? Agricultural products, things like corn, soybean, wheat, and all that. To cover their risk only, they form derivatives. Yeah. So derivatives can now be structured on anything, right? Because those days the weather was also part of the risk. It formed part of the risk, and to cover the risk of the weather, there were weather derivatives or weather futures. Right. It's a very interesting product. Although what we learn are mainly financial derivatives, you can also move into other derivatives. Now, derivatives can be structured on foreign exchange rates, interest rates, commodity prices, anything under the sun. You name it, you have a derivative. Can be on credit risk, like credit default swaps, right? On foreign exchange rates, interest rates. We discussed last week how you switch from a floating rate to a fixed rate. So that will be, well, if it's fixed structured in dollars, it will be based on LIBOR. Then you have credit derivatives, right? Things like credit default swaps, which actually led to the subprime mortgage crisis, right? So what caused the subprime mortgage crisis was the excessive use of credit default swaps. They got triggered unexpectedly, and the rest is history, right? All the banks ran out of liquidity, no liquidity, Lehman Brothers went under, things like that happened. It was a real mess at the time. Right, so credit risk, equity, share prices keep fluctuating. Then you might have heard of things like convertible debentures, right? Employee share option schemes or ESOPs. Then on bonds also you can structure derivatives. Then the derivative market size, you don't have to memorize any of these. They'll never get tested at the exam. Huge market, massive. Why would you use derivatives? Why use derivatives? What do you all think? One is to hedge your risk or to manage your risk. Risk mitigation, you cannot eliminate the risk, but you can manage it. You can reduce the cost, enhance returns, and allow investors to manage risk with greater certainty. Then it can be used for speculation. You can use derivatives to speculate. That means to like to trade for trading purposes. The biggest market is the speculative market, not the actual transaction or trade back market. Can be used to risk mitigation means fluctuation in all kinds of financial prices, including foreign exchange rates, interest rates, and commodity prices, can affect our earnings. Right? So there is uncertainty when it comes to these things, and it can be mitigated using derivatives. Therefore, you can have the need of certain instruments to mitigate these risks, which could be facilitated through derivatives. Right? So derivatives can be used to facilitate risk management. Derivatives can be used to hedge risk, to speculate, to lock in an arbitrage profit. What is an arbitrage profit? What do you mean by an arbitrage profit? Arbitrage profit means you make a profit without taking any risk. Right? Arbitrage. Risk-free profit. It's called arbitrage. And how does it work? Can any of you remember? Remember, I explained using a pen and the clip. If the pen plus the clip equals the marker, and there is ample supply of pens and clips separately. Right. So if the pen is priced at 100 rupees and the clip is priced at 5, but the marker is priced at 120, do these add up? Yeah. How would you arbitrage from this? Yeah. How would you arbitrage? Yeah.
Sir, is it like buying the pen at ₹100 and then clip separately for ₹5?
Yeah.
Then combine it and sell it for ₹120?
Exactly. Exactly. Fantastic. Right. So you buy the pen separately for 100 rupees. You buy the pen for 100 rupees. You buy the clip for 5 rupees. You spend a total 105. You put them together and you sell the pen for 120. Arbitrage profit. You are not taking any risk. Simply making money. Arbitrage. Derivatives can be used for arbitrage also. Now, if this was not a pen, if it was a let's say a debenture. Debenture, and the flip was the call option. You put the debenture and the call option together, you get convertible debenture. Right? What would you do now? Same concept. Same concept. What would you do now? Yeah. How will you make an arbitrage profit out of this? Yeah. What will you do? How will you make an arbitrage profit? Sanjeev, why don't you take the question? Same answer.
So similar to that, buying the debenture for 100 and under call option for 5 rupees, then sell a convertible debenture for 120 rupees.
Exactly. Right. You buy the debenture separately, buy the call option separately, and you sell the convertible debenture. Straight away, you make $15 without breaking any sweat. You won't bet an eyelid. No need to bet an eyelid. Just make profits. Arbitrage. So derivatives can be used to arbitrage also. This is an example. Right. To lock in an arbitrage profit to change the nature of liability. Now, last week, can you all remember we discussed swaps? Under swaps, where you change from paying, you switch from paying a fixed rate to paying floating, or the other way around, where you switch from floating to fixed. That is called arbitrage. That's called changing the nature of a liability. That you are switching from fixed to floating or floating to fixed. So you have changed the nature of the liability. Then to change the nature of an investment without incurring the cost of selling one portfolio and buying another portfolio. Right? Something like this. Let's say you have invested 100% in bonds. Right? Your entire portfolio is invested in bonds, and you have a mandate to invest only in bonds, not allowed to physically invest in any other asset. Right? Now, if you want to switch, if you see that stock market is giving a good return, and you want to switch, you are not allowed to physically sell any of the bonds. How will you do it? Which instrument will you use? Right? You understood the question. You have, let's say, 100% of your portfolio. Let's assume it is a billion rupees, right? 1 billion rupees invested in bonds. 1 billion rupees invested in bonds, and all of a sudden you notice that bond market returns are not doing that well, and inflation is picking up. So you don't want to hold on to bonds, but you want to earn equity market returns, because the equity market is booming, right? And you're stuck with a bond portfolio, but you're not allowed to sell this. How can you use a derivative to earn bond returns, not bond returns, to switch from bonds to equity market returns? What can you do? How will you do it? How will you structure it? Now, this is, if I was the examiner, right? If I was the examiner, this is the kind of question I will ask. I will not ask you anything else. This is what I will ask. Practical scenario. You have a bond portfolio. Bond returns are diminishing, right? And equity market returns are becoming very, very attractive. Bond market is becoming illiquid. How can you switch? You are not allowed to sell bonds. Right? You are not allowed to sell bonds. But how can you switch from bond returns to equity returns without actually physically selling your bonds? How will you do it? Right? What is going to be your strategy? Yeah. Now, this is where you need to put your thinking caps on. Yeah. Right. So 100% invested in bonds means what is your return? What will be your return? You will be earning bond returns, isn't it? Bond returns, right? But you want to switch from earning bond returns into equity returns. How can you do it? One thing you can do is you can do a swap. what would be the swap? You go to a bank and you tell the bank that you will pay the bank bond returns, right? So let's say 1 million bond portfolio. And you ask the bank to pay you the return on the ASPI or the S&P. Right? On an annual basis. So every year, you pay the bank bond returns, or maybe quarterly, monthly, or any time period that you prefer. Like you pay the bank the return that the bond gives, like maybe 10%. And the bank will pay you the return that is generated by ASPI. So some quarters, you're doing quarterly, some quarters it might be 15% return. Some quarters 25%. Other quarters might be negative returns when the ASPI falls. Okay. So physically, now this happens on the notional amount of 1 billion rupees. On 1 billion rupees, you're paying the bond return, and the bank is paying you ASPI or S&P returns. So if you take the net, you're getting the ASPI or S&P returns. Then you're receiving T bond returns, and you're paying the bond return. That's if you net it off, you're left with market returns. Right? You still hold on to the bond portfolio, you haven't sold it, but you have used a swap. This is called a debt to equity swap. You swap from debt to equity. Okay. Simple swap. So you have switched to another asset class without physically selling the assets that you had. All right. So any questions on this? No? By the way, yesterday was a very interesting day because of the budget. First reading of the budget, very interesting. Lots of people are talking about some super gains tax and all that, so it has been implemented. There's a tax surcharge of 25% applicable for companies which are earning more than $2 billion. Right? So some of the banks, most of the listed banks will have to pay it. And some of the big corporates and individuals will also have to pay. Right? Interesting development. So it's a retrospective tax, but I guess it was coming. And, then we had financial services taxes were increased from 15% to 18%. Yeah, so things like that. And so there are certain sectors like the energy sector, livestock, agriculture, they got certain allocations. Okay, so interesting to see how it goes. And there's plenty of hope that things will turn out well. So let's hope for the best. Right. Yeah. So you change the nature of an investment without incurring the cost of selling one portfolio and buying another. You don't have to actually physically sell. You can switch from one to the other. But you have to use derivatives with utmost care, because it can lead to huge losses, massive losses, like what happened to CPC when they tried to hedge the oil price risk. So it is risky, have to be used with care. If you don't handle it properly and if you don't understand the products, it's better to study it and come back. Otherwise, you might end up with huge losses, right? So there I have given some examples. Then it's exposed to counterparty risk. Counterparty risk is also there present. Right? Meaning, it's like default risk. The party which has an obligation might default from the obligation. They might not settle. And so it's exposed to counterparty risk. It can be high risk or small and inexperienced investors. If you are inexperienced, if you're small, can pose high risks. Massively leveraged. Right? You know what leverage is. So can be leveraged too. Right? Do you all know what leverage is? We discussed leverage some time back. What is leverage, if I may ask? Yeah. What is leverage?
The amount of debt used to finance an asset.
The amount of debt used to finance an investment. Very good. Yes. Yeah. Yeah, that's quite right. Well, so leverage. This we have done earlier also. If you have $100 invested at 10%, and this 100 is your own money, after 1 year you will end up with a return of 10. Right? But if you're not happy with this return, what you can do is you can borrow 1,000. So you borrow these own funds, then you borrow 1,000 at 8%, and you borrow 1,000 at 8%. So you pay interest of 80, and you put it in the same investment. Let's say 10%. You earn 100. right? So end of the day, you make a net return of 30, which means your return on investment is 30%. It's not 10%. Okay. But so after 1 year, you can settle your loan also. But by any chance, if your borrowing cost increases to 12, you will pay interest of 120 and end up with negative 10, right? Which is a negative 10% return. Now this is called leverage. You borrow and invest is called leverage. Leverage is profitable for as long as your borrowing cost is less than your return. Otherwise, leverage is disaster. So leverage is beneficial if return is more than cost of borrowing. Right, so any questions? No questions, we can continue. Right, so derivative classifications we discussed earlier. Credit derivatives, you have interest rate derivatives, commodity, equity, foreign exchange. And these are the main types of derivatives: forwards, futures, options, and swaps, right? So forwards, swaps, and futures we discussed last week. Let's go ahead with options today. Okay, so for a moment, let us forget about options, right? So let's say you have sorry, let's assume that you need to buy mangoes. Mangoes, eh? Today is 13th of November, and you need your mangoes on 31st December, not today. Right. 13th November. You need mangoes on 31st December. The price of a mango today, let us say, is 100 rupees. Price of a mango today, 100. Right. So you come to me and you ask me at what price I am willing to sell mangoes on 31st December. So I will tell you that I will sell you mangoes on 31st December at a price of 150. ₹150. You can buy mangoes from me at a price of 150 rupees. But I give you some additional benefit, small benefit. I tell you that on 31st December, it's not compulsory that you buy mangoes from me. If you want, you can buy mangoes from me. Otherwise, you can buy mangoes from the market. But if you buy from me, you have to pay 150 rupees. But it's not compulsory. If you want, you can buy from me. Otherwise, you buy from the market. Okay. So I have given you a benefit. Now, you will buy from the market if the price of a mango is more than 150 rupees or less than 150 rupees. Now, you buy from me if the price of a mango is more than 150 or less than 150.
More than 150 in the market.
Exactly. If the price is more than 150, you will buy from me. So I have given you a benefit, or is it a benefit or not? Is that a benefit that I have given you? Of course, right? Because it's not like getting married. I have not made it compulsory that you pay me 150. If you want, you can pay 150, or you can buy it from the market at a lower price. Right? So you won't come to me if the price is lower, which is a benefit. Now, I never give a free lunch. No? Never. Right? For every benefit I give, I charge. So today I tell you, you have to pay me 10 rupees for this benefit. Right? To enjoy this benefit, you have to pay me 10 rupees today. So you happily pay me 10 rupees and you go away. Now we have a contract between us. At 31st December, if you want, you can buy mangoes from me at a price of 150 rupees. Okay, so this is agreed today. Now, on 31st December, if the price of a mango is 200 rupees, price of a mango in the market is 200 rupees, what will you do? Will you buy mangoes from me or will you buy mangoes from the market? Yeah. What will you do? Yeah. Will you buy mangoes from me or from the market?
Buy from you.
Yes, of course. you will buy from me, right? At what price? 150. You buy from me at what price?
$150.
Yeah. At 150. So you will make a profit of
₹40.
very good. Market is 200. You're buying at 150, but you have paid me 10 rupees already. This one. So you will make a profit of 40 rupees. Correct. Agreed. So it is 190. The price of a mango is 190. Right. Then what happens? If it's 190, will you buy from me or from the market?
Buy from you.
Okay. Very good. You buy from me. And you make a profit of
30.
yeah. So my next question is, when will you break even? Okay, so at 180, to make a profit of 180 minus 1 minus 10, 20, then 170. Make 170 minus 10 is 10. At what price will you break even?
$160.
Yeah. At 160. At 160, you buy from me or from the market?
From you, sir.
You buy from me. Okay. And you will break even. Then at 155, you buy from me or from the market? 155.
From market.
On the market. So if you buy from the market, you will have to pay how much?
$155.
155. But if you buy from me, yeah. If you buy from me,
160.
no. At what price would you buy from me?
$150.
Yeah, 150. So you prefer to buy at 150 or 155?
150.
Meaning you'll buy from me or from the market? Will you buy from me or from the market?
From you.
Yeah, you buy from me, right? So you'll still buy from me. And you will make how much profit? Or loss? You will end up with a loss of 5. Okay, because if you don't buy from me, you buy from the market, you pay 155. Right? Then, but if you buy from me, you save 5 rupees out of that. Okay, but you have paid me 10 rupees already, so you lose 5 rupees. So at 150, you are indifferent. No, if you buy from me, you pay 150. You buy from the market, you pay 150. So this is 10. What happens at 140? 140? Buy from me or the market? At 140, what would you do? Would you buy from me or from the market?
From the market.
From the market. So you are not using the contract between us, right? It is not being used, but you have paid me 10, so you will lose 10. Then at 100, from me or the market? At 100?
From the market.
From the market. Right? So you are not coming to me, this contract is not being used, but you have paid me 10, which you will lose. Then if mangoes become worthless, will you come to me? No. Right? But you have paid me 10, so you will lose that. Right? Now with these figures, if I plot a small diagram, let's put this as the market. Sorry. You all can see the board, no? Let's plot the profit against the market. And at 0, when the market is 0, you make a 10 rupee loss. And until it goes to 150, you are at a 10 rupee loss. It turns, you break even 160 and goes up. Right? So this is what it
Excuse
will.
me, sir.
Yeah.
Please explain the graph again, sir.
Okay, sure. Start from scratch. You can see the graph, right?
Yes.
Can you all see
Yes.
the graph?
Yes.
Right. So this is the profit done. This is the profit figure. Okay. So I'm plotting the profit against the market prices. Right? Now, when the market price is 0, when the market price is 0, you make a loss of 10, isn't it? Understood?
Yes.
Yeah. Sorry, even when the market price is 100, you make loss of 10. And in fact, until the market price reaches 150, your loss remains at
10 rupees.
10 rupees, right? So it's flat at 10 rupees until 150. Clear?
Yes, sir. Thank you.
Yeah, and you will break even at what price?
$160.
At 160, you break even. Beyond that, you make profits. So this is what it will look like. All right. So now these are the profits that you would make. Okay, and your profit will be my loss. Okay, so whenever you make a 40 rupee profit, that means I make a 40 rupee loss. If you add the two, it comes to zero. It's a zero sum gain. Whenever you make 40 rupee profit, I make a 40 rupee loss. When you make 30 rupee profit, I make 30 rupee loss. So when you make a 10 rupee loss, I make a when your loss is 10 rupees, I make a loss of a profit of
10 rupees.
10 rupees, right? So if I plot my profit diagram, it will be the mirror image like this. Right? That's how it would look like. Now this contract you have purchased from me, so you are long. I have sold the contract to you. I am short. Right? So this contract has given you the right without an obligation to do what? It has given you the right without an obligation to
buy.
To buy what? To buy what? Complete the sentence. To buy?
Mangoes.
To buy mangoes, exactly. Now at the exam, that is what you need. You need to complete your answers. Right? At the exam, don't just say to buy or to sell. You must say exactly what you mean. Don't keep half in your head. Always write it down. Then you get full marks. Otherwise, you won't get. Okay, so this is why it's very important that we interact. It's very good that you all are answering. Then I can correct you. Okay. So you know the answer, but at the exam you might not get marks for this reason. You don't give complete answers. Understood?
Yes, sir.
Yes, sir.
Yes. So make whatever mistakes you want in class. It's good if you make as many mistakes as possible, but don't make mistakes at the exam. Right? Right. Okay. Now, it is a contract which gives you the right but not the obligation to buy mangoes from me. Okay. So it gives you the right but not the obligation to buy mangoes. Right. Mangoes is called the underlying. So although I use mangoes, it can be anything under the sun. Can be an exchange rate, can be an interest rate, can be a commodity, anything. Now, you can use this contract on 31st December. That is called the expiry date. Right. And the price that is mentioned here is 150. That is called the exercise price. Or the strike price. The 10 rupees that you pay me is called the premium. Now, when you buy insurance, you pay a premium. This product is also like an insurance product. Like you pay a premium. 100 rupees is a spot rate. And this diagram is called the payoff diagram. This product which gives the right, but not an obligation. Remember, very important point is called a call option. A call option. It's called a call option. Is there any questions on this? Now, if you look at this diagram, it has three distinct regions. If I draw a line, either side of 150, to the left of 150, it doesn't get exercised. That's called out of the money. At 150, it may get exercised, may not get exercised. That's called at the money. Above 150, it will get exercised. It's called in the money. Right, so three regions: out of the money, at the money, and in the money. So the profit you make, right, for the long, your profit would be what? It's the market price minus strike minus premium. Market minus strike is called the intrinsic value, which will never be negative. Intrinsic value can never be negative. I may ask you a few questions based on what we discussed, just to see whether you understood the concept. Let's say you're long a call option, that means you have purchased a call option. What would be your maximum profit? Maximum profit if you're long a call option would be what? If you're long a call option, what would be your maximum profit?
There's no limit to it.
Exactly. Very good. That means you have understood it perfection. Right? Because higher the price of a mango in the market, higher your profit. No? So what is the highest price a mango can go up? The highest price a mango can go up to is infinity, isn't it? You agree or disagree?
Agree.
Yeah. So the maximum profit would be infinite. Maximum loss, maximum loss. If you're long, your maximum loss would be
10
how much?
rupees.
10 rupees. What is the 10 rupees?
Premium.
The premium. Then if you're short, your maximum profit would be
$10.
good. Which is the 10 is the
Premium.
premium. Maximum loss what is the maximum loss? Yeah. What would be your maximum loss? Remember, it's a mirror image. Right? Maximum profit to the long would be
Unlimited.
the maximum loss for the short, infinite, technically. Clear? So this is all you need to know about call options. Understood? Any questions on that? Right. Now, who pays the premium to whom? The long pays the short or the short pays the long? Premium is paid by whom?
The buyer.
Long.
Yeah. The long has to pay the short. Right. Now the option that we discussed can be exercised on 31st December, right? Meaning on expiry date, it can be exercised. But there is a type of option which can be exercised anytime before it matures. That means between today and 31st December, any day it can be exercised, which is more flexible. That is called an American option. American option. If it can be exercised only on maturity date, it's called a European option, which can be exercised only on the maturity date. Remember that, American and European. American can be exercised anytime until it matures. European can be exercised only on the expiry date. Which one do you think is more expensive? The American will be more expensive, or European will be more expensive? If everything else is identical, do you think the American option will be more expensive or the European option will be more expensive?
American.
Yes, why?
You need not wait till the maturity date.
Yeah, it's more flexible. So it is cheap. Well, I keep getting a lot of budget updates. So unfortunately, some of the bad news is that the price of alcohol also has gone up. So there is good as well as bad. All right, so you understood the difference between American and European? All right. So now let's move on to the next one. Okay. Now in this case, you wanted to buy mangoes from me. Now, what if you have a mango plantation and you want to sell mangoes to me? 13 November, 31st December. Price of a mango or the spot rate, let's say, is 100 rupees. And you come to me and ask at what price I am willing to buy mangoes on 31st December. So, right? So I tell you, I will, if you want, you can sell mangoes to me on 31st December at 80 rupees. 80. Now that we know the terms, let's say this is the strike price, is 80 rupees. So I will tell you that if you want, you can sell it to me or you can sell it in the market. Right? So I have given you a benefit for which you have to pay. Let's say you have to pay me 5 rupees for the benefit. Right? So the premium in this case is 5. But this is actually the insurance product. Huh? This is how insurance works. You're paying me a premium of 5. Right? I will buy mangoes from you. You can sell mangoes to me at a price of 80. Remember the early example, the difference is you can buy mangoes from me, but here I will buy mangoes from you. Or you're selling mangoes to me, right? You're selling the mangoes to me. So I will buy it at 80. Now you will use this option, or you will sell mangoes to me at 80 if the market is more than 80 or if it's less than 80. When will you sell mangoes to me?
Less than 80?
Yeah, if the market is less than 80, you will sell it to me at 80. Right. So let's do another analysis like what we did earlier. If the market is 100, right, will you sell it to me or in the market? Market is 100. Let's put down several prices. If the market is 100, will you sell it to me or will you sell it in the market?
Sell it to market.
Sell it to the market. Right, so you are not using this contract, meaning you are losing the 5 rupees. So you will end up with a profit loss of 5. Can you see the board if I write it here? Then if the market is 90, if the market is 90, will you sell it to me or will you sell it in the market?
Market.
Yeah, you won't use the contract, so you will lose 5. And if it's 80, you can either sell it in the market or you can sell it to me. Right? If you sell it to me at 80, you sell it in the market at 80, it doesn't make a difference. So you will still lose 5. Am I right? Now, can you tell me at what price will you break even? What price will you break even?
At 80.
At 80. At 80, you can either sell it to me or sell it in the market, right? So you're not making anything from the contract. No profit from the contract. But you have paid me 5, which you will lose. My question is, at what point will this become 0? Now, what happens if the price is 75? Market price 75? Yeah. If the market price is 75, will you use the contract or not? Will you sell it to me or sell it to the market? If the market is 75,
Sell it to you.
yeah, you sell it to me and you make a profit of 5. No? But you have paid me 5, so you will break even. Then if the price of a mango is 70, will you sell it to me or sell it in the market? Price of a mango in the market is 70. Will you sell it to me or will you sell it in the market?
Sell it to you.
Yeah. And you make a profit of 80 minus 7. 80 minus 70 minus 5. You make a profit of 5. Then at 50, $80 minus 50 minus 5 is 25. If mangoes become worthless, no one wants mangoes. You sell it to me or sell it in the market?
Sell it to you.
Yeah. And you make a profit of? $75. Clear? So once again, if I plot a diagram, right, the profit against the market, when the market is 0, you make a profit of 75. Right? And when the market is 75, you break even. At 80, you make a loss of 5. Okay, clear, understood. Right. So this is, you have bought the contract from me, you're long. I have sold it to you, I am short. This contract will get exercised below 80. So this is in the money. 80 is at the money. And above 80 is out of the money. Right? So if you look at this contract once again, it has given you the right without an obligation to do what? The right without an obligation to it gives you the right without an obligation to
Sell mangoes.
sell mangoes. Right? So mangoes again is the underline. Okay. So this is called a call option. it gives you the right without an obligation to sell the underlying. Okay, now let's do the same calculations. The profit, if you're long, would be strike minus market minus the premium. Strike minus market is called the intrinsic value, which will never be zero, which will never be negative. Intrinsic value can never be negative. So what is your, if you're long, what is your maximum profit? If you're long, your maximum profit would be yeah. If you're long, your maximum profit would be what? Yeah. You're long, your maximum profit is what? 75, which is strike minus the market. Maximum loss. If you're long, what is your maximum loss? Hello? Yeah, if you're long, your maximum loss is 5, which is the premium. Right, so it's easy to remember whether it's a call option or a put option, your maximum loss will always be the premium. Huh? Then if you're short, the mirror image maximum profit is the premium and maximum loss is your strike minus market. Okay, so that's a call option. That's all you need to know about call options. The important thing is this diagram is called payoff diagram. You need to memorize the diagrams. Long call, long put, those things you need to memorize. Also, it's easy if you can memorize the maximum profit and the profit calculations and all that, maximum losses. Those things are standard. You don't have to keep remembering. Okay. Now, if you look at these, what is the riskiest thing you could do? The riskiest thing, meaning where you can make the maximum loss, right? Maximum loss for the put option. Sorry, what am I saying? It's not a call option. This is called a put option, right? It gives you the right without an obligation to sell the underlying. Right without an obligation to sell the underlying. Okay, so this is a call option. Here is a put option. The riskiest thing is where you can incur the maximum loss. Maximum loss, if you look at each of these cases, is this. And this is the riskiest strategy. Very risky thing to write or sell a call option. Go short, call option is the riskiest thing you could ever do. Clear? So that's all you need to know about options. Right. Shall we try this example? long put. Strike price 100, premium 4, stock price is 90. So what do you all think? This is in the money, out of the money? Is it in the money or out of the money? Yeah. It's in the money, right? Because the option will get excised. So your profit would be the strike minus market minus the premium. Strike 100 minus market 90 minus the premium of 4. Which comes to $6. Clear? Part 2, short, strike price 100, the short put, strike price 100, same question, premium 4 and stock price is 110. Right. So the profit in that case is very straightforward. You make a $4 profit. The option is out of the money, which means if you are short, you make a $4 profit. Okay. Clear? Any questions? Right. Inputs for pricing options can be exercise price. There are several inputs. One is the exercise price. Now for call options, lower the exercise price, higher the premium. For put options, higher the exercise price, higher the premium. That means these are the variables, right? For call option, low strike, higher premium. So it's an inverse relationship. I'm not going to detail to explain it. For put options, higher the strike, higher the premium. It's a positive relationship. So remember, if it's anything to do with price, call option, as inverse relationship, put option positive relationship. All of the factors for both options have positive relationship. That's the easiest way to remember. If it's anything to do with price, call option has inverse relationship. All of the factors have a positive relationship to each of the variables. Right? That's the easiest way to remember these relationships. Options settle. You have to give the specific time and the date, and you have to specify whether it's physical delivery or cash settled. Okay, let's get back to this question also. You are asked to calculate the value of the following call options. So it's a call option. Strike price 100, premium is 4, the stock price is 90. You're long, so your profit at 90 is minus 4. Like you will lose the premium. Then short call, strike 100, premium 4, stock price 110. So if you were long at 110, your profit would be the market minus strike minus premium. Market 110 minus strike of 100 minus a premium of 4 is $6. Right, so your short 110 means your loss would be $6. All right. Third question. A Sri Lankan exporter will receive 1 million yen in 3 months. He expects the current yen rupee rate to increase to 90. What is the protection that he can get if from an option strategy if his view does not materialize and the yen rupee increases, right? So this guy is a Sri Lankan exporter and he's receiving yen. So he will benefit if the yen appreciates, right? It's currently 84. If it goes to 90, he benefits. But there is no guarantee that the yen will go to. Sorry, this is what we did. The calculation. There is no guarantee. Going back to the question, there is no guarantee that the yen will go to 9. If it falls, what can he do? The answer is he needs to buy an option which gives him the ability to sell yen, right? Because he needs to sell yen, he's getting yen which he has to sell, right? So an option which gives you the right to sell is called a put option. He needs to go long put option on yen rupee at a strike price maybe at 80, right? You have to go out, buy out of the money options. Always buy out of the money options. Otherwise, option premium is going to be very high. So buy out of the money options, strike price maybe at 80. Out of the money put option. Buy out of the money put option on the yen rupee, right? Which gives him the right to sell yen. That should be your answer. Understood? Right. So the next area is on option premium. Option premium is equal to intrinsic value plus time value. Right? So intrinsic value is always positive. We discussed how to calculate intrinsic value. And time value is the value that an option gets due to the time it has until maturity. Right? And as it approaches maturity, the time value approaches 0. So let's try this example. The following prices were reported on June 2014 and December 2014 call options of ABC. The price of the call option for the premium is 35.75. Strike price 66. Spot 80.75. So it's a call option. You have to calculate intrinsic value. Remember, intrinsic value of an option, call option, is the market minus strike. So the market is the spot price of 80.75 minus strike price 66, which gives you an intrinsic value of 14.75. Put it in this equation, substitute it in the equation. Premium is 35.75. Intrinsic value is 14.75 plus time value. The time value comes to 21. Is the option in the money? Answer is yes, because intrinsic value is a positive number. Right? If intrinsic value is positive, that means it is in the money. Then price sensitivity of an option. This measures how an option premium changes with various factors. Right? The sensitivity of an option premium to changes in the underlying price is called delta. The sensitivity of delta to changes in underlying price is called gamma. And the sensitivity of the premium to changes in time is called theta. Sensitivity of the premium to changes in volatility is called vega, and the sensitivity of option premium to changes in interest rates is called measured by rho. Option strategies we can skip. Right, straddle means you buy a call option and a put option at the same strike price. It's expensive because you're buying two options. Strangle is similar to straddle, only thing you're buying a low strike put and a high strike call, so it's cheaper than a straddle. Bull spread is where you buy a call option at a low strike and sell a call option at a higher strike, right? So that overall your premium will be less. Bear spread, you buy a put option at a low spread, low strike, and sell a put option at a higher strike. Sorry, you buy a put option at a higher strike, you sell a put option at a low strike, so that you reduce the premium. Butterfly spread, you buy a call option at a low strike, sell two call option at a medium strike, buy a fourth call option at an even higher strike. Right? So if the market is stable, then you make profits. But if it becomes volatile, you lose. Let's try these examples. How to hedge underlying positions. Purchase a call option to protect a short position. Let's do the example, then you will understand. A Japanese importer has to pay $2 million in 3 months. Right? Japanese importer. So he's residing in Japan. He has to buy dollars. The risk is if the dollar appreciates, he will lose. Current yen rate is 90 and he feels the yen rate will drop to 85. If it drops, he benefits. But the risk is the dollar yen rate going to 100. Right? If it goes above 90, he will lose. So what he can do is he can buy a call option on the dollar yen, right? Buy a call option on dollars on the dollar yen, buy a call option on dollars on the dollar yen with a strike price above 90, maybe 100, right? With 3 months to expiry. Buy a call option on dollars on dollar yen with 3 months to expiry at a strike price of 100. Or you can just say buy an out of the money call option on dollars on the dollar yen. Next one is Sri Lankan tea exporter is expecting to receive dollars in 3 months. The dollar rupee is 134.25 and 3 months forward is 40 cents. So you engage in a forward contract to sell dollars at 134.65, thinking that the dollar will drop against the rupee. The current exchange rate 134.25, 3 months forward is 40 cents, meaning 3 month outright would be 134.25 plus 40 cents, 134.65. So if he is an exporter, he can either book forward. So if the exchange rate drops, he will benefit. But if the exchange rate goes to 150, he will lose. So what he can do is he can buy a put option on dollars on the dollar rupee, maybe the strike price of 130. Right? So if it falls anything below 130, he can sell it at 130. Otherwise, he enjoys the upside. Next example, stock of A is trading at 100 rupees and the fund manager sells 110 rupee call options at a premium of 1. The fund manager will forfeit participation in the upside movement if the stock is above 110. And so this guy has purchased his share at 100 and he has sold call options, right? Sold call option means if you're long a call option, you have a right to without an obligation. But if you're short, in this case, you're short call option. That means you don't have a right, you have an obligation only. Right? So if this guy wants to buy, if the person who bought the call option from you wants to exercise the option, if the price goes above 110, it will get exercised. Right? That means you're supposed to sell it to the person who bought the call option, and he will exercise at 110. Okay, so you can sell it for a maximum price of 110. You can't sell it anything beyond that. Maximum price you will sell it 110. But you have collected premium of 1 rupee. That means your cost will reduce from 100 rupees to 99 rupees. Your cost is going to go down because you're collecting premiums. You're selling a call option and you're collecting premium of 1. So that will reduce the cost. Right? But your maximum profit will be 11 rupees, 110 rupees minus 99. Then callers is where you combine a call option and a put option. Right? So that you buy a call option and long, in other words, let's put it technically, long call plus short put. Right? So when you buy a call option, you have to pay the premium. And when you sell a put option, you will receive the premium. So your net premium is the put option premium minus the call option premium. That's called a collar. So what happens is, if you market profit, I'll put this as market now. It's not the payoff diagram, I'm just doing. This will be the call option strike, and here we have the put strike. Right, so anything in between, you get the market price, but if it goes above this, you can exercise the call option, and if it falls below, the put option will be exercised. So the price always fluctuates between these two bands. So no matter how much the price falls, you will not benefit from the drop because the put option will get exercised. That is what happens to CPC. Right. So if the call option premium, if the call option premium is equal to put option premium, you're paying a zero premium. That's called zero cost. Okay, so that's all we have on options. Did you all understand? Any questions on options? If there are no questions on options, let's move on to the next area, which is on Ascertain liability management. Right. Right. The next area is on ALM, Ascertain liability management. Right. So banks are in the business of accepting deposits and lending it out, which means normally if you take your banks, you will be taking deposits on the liability side. Most of your liabilities will run to a maximum of 1 year. Right? Maximum you have 1 year FDs. Very rarely only customers will deposit for longer tenors. Right? 5 year deposits very rare. On and off you might do some debenture issues, which will run to maybe 5 years maximum. Very rarely you get 10-year debentures. Right. But on the other hand, your assets right, have longer maturities. Assets will have longer maturities. Your housing loans, for example, can run up to about 15-20 years. Right? Whereas personal loans maybe 5 years or 7 years. So you always have a mismatch between your asset maturities and your liability maturities. So in between, if your assets if your liabilities mature, your FD rates mature, and all of a sudden you find FD rates have increased, you might not be able to still change your lending rates, right? Because you have given long-term housing loans at very low interest rates. Then that might be a loss. On the other hand, if interest rates on liabilities go down, you will benefit, right? So there is always an asset liability mismatch, which needs to be managed. Right. Bankers make decisions every day on buying and selling securities, making loans, funding their investments. These decisions are based on outlook of interest rates, composition of assets and liabilities, and degree and willingness to take risk. They will affect the bank's net interest income and balance sheet values. Now, if you take your ALCO, who sits on the ALCO? Usually, who sits on your ALCO? Yeah, who sits on an ALCO? Hello.
Is it treasury, sir?
Yeah, the treasury assets. Who else? One man show. Who else would sit on an ALCO? Well, the CEO would sit. Maybe the CFO. Then the head of risk. Right? Perhaps the head.
Product heads.
Pardon?
Like product heads.
Exactly. Yes. Very good. Product heads, right? Maybe the heads of retail and corporate banking. The head of sales. So these guys will sit at ALCO meetings. And ALCO decisions are usually long-term or short-term?
Short term.
Yeah, short-term. They usually make decisions for 2-3 weeks, maximum a month. Right? So long-term strategic direction is given by the board, but ALCO decides on short-term decisions. Right? And the main focus of ALCO is net interest income, which is interest income minus interest expense, and the net worth or the equity. Right? The process of making such decisions about the composition and assets and liabilities, the composition of assets and liabilities and risk management is known as asset and liability management. These decisions made by the Asset and Liability Management Committee. These decisions are made by the ALCO or the Asset and Liability Management Committee. Right? They decide on the composition of assets and liabilities. ALCO is responsible for overall financial direction of the bank. ALCO's goal is to manage the sources and uses of funds on the balance sheet and off-balance sheet activities with respect to interest rate and liquidity. And so they will look at things like interest rate risk and liquidity risk. ALM is generally short-term and tries to achieve near-term financial goals. The traditional purpose is to control the size of the bank's net interest income, which is something to do with the dollar gap, and it considers the effects of the changes in the value of the balance sheet, which is called the duration gap, the dollar gap and the duration gap. Okay, so remember these are the two things that ALCO will focus on, the dollar gap as well as the duration gap. Net interest income is the difference between the interest earned on the assets and the cost of liabilities, right? So net interest income is interest income minus interest expense, very easy. Net interest margin is net interest income divided by earning assets. Net interest income divided by earning assets. So what are earning assets? What do you mean by earning assets? If you take cash, it doesn't earn any interest. Like cash in the vault, no interest. Then land and buildings, no interest. So earning asset means any asset that generates interest income. So let's try this example. It says ABC has total assets consisting of 100 million 5-year fixed rate loans at 8%, 90 million liabilities consisting 30-day time deposits at 4%. You asked to calculate net interest income and net interest margin, and calculate net interest income, net interest margin, assuming interest rates increase by 200 basis points or 2%. Right, so shall we calculate? So ABC has total assets consisting 100 million 5-year fixed rate loans at 8%, 90 million liabilities, 30-day time deposits at 4%. Net interest income. Is interest income minus interest expenses. So interest income, assets 100 million at 8%. Minus interest expense, 90 million liabilities at 4%. Get 4.4 million, net interest income of 4.4 million, right, per annum. Right? The net interest margin is your net interest income divided by earning assets. Net interest income 4.4. And earning assets 100 million. So your net interest margin 4.4%.
So, small doubt for interest expense, is it for 30 days or else for 1 year?
Okay, well, I assume that you will keep rolling over the same deposit up to 1 year. Right? There's no other details are given, otherwise there is a mismatch.
Okay, sir.
Okay. Good question. Then calculate net interest income and net interest margin, assuming the interest rate increase of 200 basis points. If interest rates go up, what happens? They have a 5-year fixed rate loan. So if interest rates increase by 2%, will the 5-year loan rate change? So if interest rates increase by 2%, your net interest income, what is the impact? If interest rates go up by 2%, interest income will change or not change? Yeah.
There won't be significant change since both interest income and expense will go up in the same manner, since the interest went up by 200 basic points, right?
Yeah, interest rates are going up by 2%, but your loan rate is fixed for 5 years, no? You can't change your loan rate, isn't it? And you're stuck at 8% for 5 years.
Okay.
Right? So your interest income doesn't change. It remains the same. But your interest expense will increase by 2%. Because every 30 days, the rate gets revised. Right? So 90 million will go up to 6%. So net interest income will drop to 2.6 million. From 4.4, it will drop to 2.6. Am I right? And net interest margin will be 2.6%. Okay. Clear? Understood?
Yes.
Okay. So net interest income depends on interest rates on assets and liabilities. An increase in interest rates on assets will increase net interest income, and an increase in interest rates on liabilities will reduce net interest income, right? Obviously. The amount of the various earning assets and liabilities, increasing the size of the bank will increase net interest income, right? So if your balance sheet expands, that will also increase net interest income. If rates go up, it will change net interest income, because each of these factors, no? Interest income will change if either the interest rate goes up or the amount of the asset and liabilities change. Right? If interest rates change or amounts change. when the earning mix of these funds, shifting earning mix towards more high yielding assets or less costly sources of funds will increase net interest income, right? Either you can try and lend at higher rates, or you can try and reduce the funding cost. That will enhance your net interest income and margins. Interest rate risk depends on the demand and interest rates depend on the demand and supply of funds. Interest rates are determined by the interaction of thousands of credit suppliers and demanders. And demanders makes it difficult to predict interest rates. Interest rates consist of risk-free rate and risk premium to compensate credit inflation, maturity, marketability, and call risk, and so on. And so an interest rate will consist all of these factors. And so it's demand and supply that determines interest rates. Remember the demand curve and the supply curve, supply and the demand, the intersection where they intersect determines interest rates, right? So interest rates on top of that will depend on other factors like risk premiums, call risk, credit risk, liquidity risk, all that will have to be factored into interest rates. So managing interest rates, you can either have balance sheet adjustments or you can use derivatives. On balance sheet adjustments, change in the portfolio of assets and liabilities in order to change the manner in which the profitability of the bank or dollar amount of assets and liabilities change as interest rates change. Management may adjust the maturity, repricing, and repayment schedules of its assets and liabilities. Then you can securitize some of its assets to sell them to investors, right? So to manage your interest rate risk, you can do these kind of things. Right? Maybe you can push for certain type of deposits. If you feel interest rates are going up, you offer maybe higher rates for longer term deposits, maybe 5-year FDs, you offer attractive interest rates. Then you give lower lending rates for longer tenor loans so that there is attraction there, and before the rate drops, customers go and fix it. Things like that. And off-balance sheet adjustments without changing the asset and liabilities, banks can do the same using off-balance sheet derivatives such as interest rate swaps and futures. Banks can enter into receive fixed, receive floating, pay fixed IRS. If interest rates are going up, right? If interest rates are going up, you want to receive a fixed rate or a floating rate. What would you prefer? If rates are going up, will you prefer to receive a fixed rate or a floating rate?
Fixed rate.
If interest rates are going up, you want to receive
Floating interest.
a floating rate. And if rates are going down, you will want to receive a fixed rate. Right? So if you are using an interest rate swap, you want to switch from fixed. If interest rates are going up, you might want to switch from. Well, you will want actually to receive a floating rate, pay a fixed rate, right? Whereas if rates are going down, you will want to pay a floating rate, receive a fixed rate. Or banks can sell treasury futures to protect from increasing interest rates, right? If interest rates are going up, you can either receive a floating rate and pay a fixed rate, or you can go short futures, right? So we'll discuss these things in detail when we are discussing questions. Right, so when interest rates are going down, you either receive, you go long call option on interest rates, long treasury futures, or you can receive fixed, pay floating swap. Measuring interest rate risk, right? You can either measure the price risk or the reinvestment risk. Right, so these are the tools that you are going to use: dollar gap, duration gap, or you can use simulations. Dollar gap is the most common method used by banks. It is also known as the funding gap or the maturity gap. Right. So this is the important area. You should know that about the dollar gap. Right. It is also known as the funding gap or the maturity gap. Banks classify all assets and liabilities into groups of interest rate sensitive or non-interest rate sensitive assets according to whether their interest return and cost varies with the general level of interest rates. The focus is on net interest income. Now, using the dollar gap or the funding gap, you will focus on net interest income. Gap analysis classifies assets and liabilities according to their interest rate sensitivity. So we'll do an exercise, then you will understand better. Interest sensitive assets or liabilities are those that reprice. Remember, these have to reprice and not mature within some defined time period, right? Maybe 30 to 60 days, 0 to 30 days. The next bucket can be 30 to 60 days, likewise. So you have to have your time buckets. It considers repricing rather than maturity. So you need to look at repricing and not at maturity. Rate sensitivity depends on the frequency and repricing. Short-term assets and liabilities are more sensitive than long-term assets and liabilities. Assets and liabilities with long-term maturity with variable rates are interest rate sensitive. Right, so asset and liabilities with long-term interest rates. Let's say, for example, a 10-year housing loan, right? Or 15-year. Let's say a 20-year housing loan. We have given a 20-year housing loan. What it means is, say there are two housing loans, A and B, both are 20-year. Right. Say this is fixed at 50%. This is floating at PLR plus 2% monthly. Monthly rate of PLR plus 2%. Now, if interest rates change, if you look at the maturity of both of these loans, they have the same maturity, no? Both run up to 20 years. But if interest rates change, which one will change fast? A or B? Or which one is more sensitive, in other words? That means if PLR keeps changing, which one is more sensitive? Or if interest rates keep changing, which one is more sensitive? A or B? Both the housing loans, 20 years. Which one do you think is more sensitive to interest rate changes?
B.
Why? because every month the interest rate will get revised, no?
Replies, yes.
Whereas A is fixed for 20 years. Right? For the next 20 years, you know that the interest rate will not change. So B is more interest rate sensitive than A. But if you take a 30-year period, right? A 30-year period, is A sensitive to interest rate changes within a 30-year period? Within a 3-month period, it is not. But a 30-year period? Is A sensitive to interest rate changes? Yeah.
Loan gets fully paid within 20 years.
Yeah, it will get fully paid within 20 years. But if they're giving a new
What
loan,
sense?
a new housing loan for 20 years?
Yes, it gets.
Yeah, then it will get revised. No? Right. If the same customer wants another loan after 20 years, the rate will get revised. So it is sensitive within 30 years, but not less than 20 years. Right? So it's not rate sensitive for anything less than 20 years. Beyond 20 years, it is rate sensitive. Whereas the floating rate loan is rate sensitive every month. Okay, so that's what you need to look at, not the maturity, but the repricing frequency. Okay, that is what you need to look at when you look at the dollar gap. Right? So let's do a couple of examples. In rate sensitive assets, if asset's interest rate return varies with interest rate changes over some given time horizon, they are referred to as rate sensitive assets, something like this. Right? B is rate sensitive, A is not rate sensitive. Assets that reprice within the time horizon are rate sensitive assets. Short-term securities issued by the government and private borrowers, short-term loans, variable rate loans. The non-interest sensitive assets, if asset return, interest return does not vary with interest rate changes over some time, it's referred to as non-rate sensitive, right? Like long-term government bonds at fixed rates, cash, land and buildings, they are not interest sensitive. Rate sensitive liabilities, similar to assets, the same concept. If a liability's interest cost varies with interest rate changes over some given time horizon, it's referred to as rate sensitive liability, right? So if these were loans that you had taken, maybe a debenture, then it is A is rate sensitive, A is not rate sensitive, B is rate sensitive. Liabilities that reprice within the time horizon are rate sensitive liabilities, like money market borrowings and deposits, short-term savings accounts, overnight interbank borrowings, central bank borrowings, variable rate deposits. Non-rate sensitive, it has to be non-rate sensitive liabilities if asset interest does not vary with interest rate changes over time. Sorry. But rest non-rate sensitive liabilities like savings accounts, current accounts, children savings accounts, equity. Remember, equity is not rate sensitive. It's not a rate sensitive liability because regardless of what happens to interest rates, equity will not get repriced. A selection of time period over which rate sensitive of the asset and liability is crucial. An asset or liability that is rate sensitive in one period may not be rate sensitive in a shorter period, right? Like what we discussed. Remember, A is not rate sensitive for less than 20 years, but beyond 20 years, it is rate sensitive. The time period referred as maturity buckets or planning horizon. There is no standard, and each bank can decide on their own maturity buckets. In the long term, every asset and liability becomes rate sensitive. Okay, let's go through these examples. And can you all tell me which one is rate sensitive? Within 1 year, which one of the following assets or liabilities fit the 1 year repricing sensitivity test? Right? 1 year repricing bucket. $91-day treasury bills, they are rate sensitive or not? Within 1 year?
Rate sensitive.
Good. Rate sensitive. 1 year treasury notes.
Rate sensitive.
Rate sensitive. 20 year treasury bonds.
Not sensitive.
They're not sensitive. 20 year floating rate bonds with annual repricing.
Sensitive.
Sensitive. 30 year floating rate mortgages with repricing every 2 years.
Not sensitive.
Not sensitive. 30 year floating rate mortgages repricing every 6 months.
Sensitive.
Overnight Fed fund rate.
Sensitive.
9-month fixed rate CD.
Not sensitive.
It's sensitive, right? It matures in 9 months. So within 1 year, it is rate sensitive. 1 year fixed rate CD.
Not sensitive.
It's actually sensitive. It matures within 1 year now. So after 1 year, the rate will change, isn't it?
Yes, sir.
Yeah. Next one is 5 year floating rate CD with annual repricing.
Sensitive.
Sensitive.
Sensitive. Common stock.
Not sensitive.
Yeah. Good. Any questions up to now? So the dollar gap or the funding gap. The dollar gap is the difference between rate sensitive assets and rate sensitive liabilities. Total effect of interest rate changes on profitability is summarized by the dollar gap. Right. So let's see the impact. Positive dollar gap means the bank is asset sensitive. Rate sensitive assets minus rate sensitive liabilities. So if your dollar gap is positive, that means you have more rate sensitive assets than rate sensitive liabilities. Right? This is called asset sensitive. But if your dollar gap is negative, then you have less rate sensitive assets than rate sensitive liabilities. Shall we calculate dollar gap for this example? So let's say the time bucket is 3 months. Right? What is your dollar gap for a 3-month time bucket? Vault cash, rate sensitive or not?
Not.
Not sensitive. Short-term securities
Sensitive.
are sensitive. Long-term securities,
Not.
not sensitive. Variable rate loans,
Sensitive.
Sensitive.
sensitive. Short-term loans,
Sensitive.
sensitive. Long-term loans,
Not sensitive.
not sensitive. Let's assume that other assets means land and buildings and all that. So they are land and buildings are
Not sensitive.
not sensitive. Then on the liability side, demand deposits,
Sensitive.
no, not sensitive.
Not sensitive.
Yeah, because you don't pay interest. Money market, money market deposits,
Sensitive.
are sensitive. Short-term savings,
Sensitive.
long-term savings,
Sensitive, sir.
no. Long-term savings are not sensitive. Within 3 months. Okay. Central bank borrowings,
Sensitive.
are sensitive. Equity,
Not sensitive.
not sensitive. Right. So what is your dollar gap? Your rate sensitive asset base is 75 minus liabilities 105, which is minus 30. Did I get it right? Or is it 115? Huh? This comes to minus 40. Okay, so are we asset sensitive or liability sensitive?
Liability sensitive.
We are liability sensitive. Right. Okay, so liability sensitive. Huh? Okay. Any questions up to now? We'll come back to this slide later. Relative gap ratio expresses the amount of gap as a percentage of total assets. Right. So relative gap ratio is the dollar gap divided by total assets. Now in this example that we just did, the relative gap ratio is your dollar gap divided by total assets. The gap minus 40 divided by total assets of 195. That gives you the relative gap ratio. Interest sensitive ratio expresses the amount. Oh, sorry, I'll share the screen. Interest sensitive ratio expresses the amount of rate sensitive assets as a function of rate sensitive liabilities. Right, so it's rate sensitive assets over rate sensitive liabilities. So in this case, your interest sensitive ratio is rate sensitive assets over rate sensitive liabilities. Rate sensitive assets you have 75, rate sensitive liabilities 115, which is less than 1. Right, so if the ratio is less than 1, that means you are liability sensitive. Now this is the most important point about, sorry, I won't show this to you. Right, so interest sensitive ratio is less than 1, so you are liability sensitive. So this gives you the most important point about dollar gaps. Change in net interest income, right, is measured by the dollar gap into change in interest rates. Right, so this you need to remember. Remember, dollar gap is rate sensitive assets minus rate sensitive liabilities. You need to remember that equation, and you need to remember this relationship. Right. Now, if your dollar gap is positive, what is the objective of ALCO? Is it to increase net interest income or to reduce net interest income?
Increase interest income.
Yeah, increase net interest income. Right. So the change has to be a positive number. And if you expect interest rates to increase, your dollar gap should be positive or negative.
Positive.
Yeah, positive. Because you're multiplying two numbers. If one is positive, for you to end up with a positive effect, you need to multiply it by a positive number, right? So your objective is to increase net interest income, and you expect interest rates to drop. Then your dollar gap should be kept at positive or negative.
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 Sir, can you explain that once more, please?
Yeah. Let's say you multiply 2 by 3. Right? You're multiplying two positive numbers now. Then your answer will be a positive or a negative number. Will be
Positive.
positive number, right? Then if you multiply minus 2 by, your answer will be a positive number, right? Minus 2 by 3, your answer will be
Negative.
negative. Minus 2 by minus 3,
Positive.
positive. Positive 2 by minus 3,
Negative.
negative. Something we learned in grade 2, right? So the objective of ALCO is to increase net interest income or to reduce net interest income?
Increase.
To increase net interest income. Right? Now, interest rates you need to forecast. If your ALCO is forecasting interest rates and they expect interest rates to go up, right? Remember, you're multiplying two numbers, you expect interest rates to go up, means the change should be positive number. Should you have a positive dollar gap or a negative dollar gap? To increase net interest income, that means the change should be positive. If you are multiplying a positive number by, you should multiply a positive number by a
Positive.
positive number. That means dollar gap should be
Increase.
Positive. Positive number.
Yeah. So your objective is to increase net interest income. That means the change should be positive, and you expect interest rates to drop. Right? That is a negative number. That means the dollar gap has to be
Negative.
negative. Right? So you expect interest rates to go up, and your objective is to increase net interest income. You expect interest rates to go up, but so you run a positive dollar gap, right? But interest rates are beyond your control. By any chance, if interest rates drop, your net interest income will be
Minus.
yeah, it will drop, reduce, negative. Then you expect interest rates to drop, so you run a negative dollar gap, but interest rates go up. Right? So your net interest income will
Be a negative number.
be negative. Clear?
Yes, sir. Thank you.
Yeah, that is what is explained in this slide, which we skipped earlier. Remember? That's what is explained there. Okay, so shall you try this example? Consider the following balance sheet of ABC. Right, you have been given an extract of floating rate mortgages, 30-year fixed rate loans, demand deposits and time deposits, and equity. What is the expected net interest income at the end of the year? Is the interest income minus interest expense. So interest income, floating rate mortgage, 10%. 30-year fixed rate loans, 50 at 7%. Minus interest expense. Demand deposits, 70 at 6%. And time deposits, 20 at 6%. You get 3.1. Did I get it right?
So demand deposits, why has an interest rate been applied on that?
Okay. Well, at the exam, right? Never think about those and never question those. Do as
Thank you, sir.
yeah. Simple answer. Don't tell the examiner that demand deposits you can't pay interest. So this question is wrong. Don't say that. Don't say that. Now that you brought it up, is it illegal to pay interest on current accounts? Yeah,
No, it's not.
it is not. If you want, you can pay. In some countries, they do pay on current accounts. Okay, next question is, what will be the net interest income at the end if interest rates rise by 2%? So if interest rates go up by 2%, let's do the change in net interest income is the dollar gap into change in interest rates. Okay, so let's calculate dollar gap. Rate sensitive assets minus rate sensitive liabilities. Floating rate mortgage is rate sensitive. 30-year fixed rate loan is not rate sensitive. Minus rate sensitive liabilities, demand deposits, and time deposits. Both are rate sensitive. Right? So your change in net interest income is dollar gap minus 40 into change in interest rates. Interest rates go up by 2%. net interest income will drop by 0.8. Right, so it will drop from 3.1 by 0.8 to 2.3 million. Right, when interest rates go up, your net interest income will change by 2.3 million. A cumulative repricing model will work out in the next example. Incremental and cumulative gaps. Incremental gaps measure the difference between rate-sensitive assets and rate-sensitive liabilities over increments of the planning horizon. Cumulative gaps measure the difference between rate-sensitive assets and rate-sensitive liabilities over a more extended period of time. Cumulative gap is a sum of incremental gaps. If there is only one planning horizon, the incremental gap and cumulative gap are the same. Right now, if you look at this, so there are time buckets given on the left, 0 to 30 days, 31 to 90 days, 91 to 180 days, 181 to 365 days. Right, so these are the time buckets. In assets maturing within the repricing period, you have 50 within 0 to 30, and liabilities are 30. Right, so rate-sensitive assets minus rate-sensitive liabilities, you get 20. Right, so the cumulative gap for 0 to 30 is 20. In 31, you have 25 assets. 31 to 90, you have 25 assets, 20 liabilities. So the incremental gap is 25 minus 20 is 5. Right? So the cumulative gap from 0 to 90 is 20 plus 5, 25. Remember, we did cumulative cash flows. This is somewhat similar. 91 to 180, there are no assets maturing, but 20 liabilities. So your incremental gap is minus 20. Cumulative gap plus 25 minus 20 is plus 5. Then 185 to 365, no assets. You have liabilities maturing. Incremental gap is minus 5 and cumulative gap is 0. Right, so that's the difference between incremental and cumulative gaps. Okay, so this question is somewhat similar. In the interest of time, we will skip. You can try this for homework. Right, so managing interest rate with dollar gap, managing interest rate risk with dollar gap. You have two strategies. Right? You can either be aggressive or defensive. Defensive means you try to maintain a dollar gap close to 0. Now, the change in net interest income is your dollar gap into change in interest rates. Remember this equation? So what happens if you maintain a dollar gap of 0? That means if your rate sensitive assets equals rate sensitive liabilities, then your dollar gap will be 0, isn't it? So if dollar gap is 0, whatever happens to interest rates, what will happen to net interest income? If this is 0, regardless of whatever happens to interest rates, your net interest income will be, the change in net interest income will be
0.
0. Not sensitive. It tries to reduce the volatility of net interest income. because whatever happens to interest rates, your dollar gap will be, the change in net interest income will be 0. The focus of defensive strategy is to insulate the net interest income from interest rate changes, whether the direction of interest rate movement is upward, downward, predictable or unpredictable. This strategy is not necessarily passive, since many adjustments need to be done to maintain a zero gap. Right? And you don't have to forecast interest rates because you're immunized to interest rate changes. Issues under defensive strategies: you can't make use of changes in interest rates, right? Regardless of what happens to interest rates, your profitability does not change. So whatever happens to interest rates, your profitability will not change. So you can't make use of interest rate changes if you are defensive. Then now customers, if they want long-term loans and you're not willing to give long-term because you expect interest rates to go up, then customers will not be satisfied. The expertise management in sophisticated financial instruments such as options, futures, and swaps, right? So you may have to use derivatives, which need a separate skill, and you're taking on different risk profile. Then aggressive ALM, it tries to raise the level of net interest income, right? You try to forecast interest rate changes. The focus of aggressive strategy is to increase net interest income through altering the portfolio. Success depends on the ability to forecast interest rates. It involves 2 steps: predicting the direction of interest rates, right? And adjustments must be made to interest rate sensitivity of assets and liabilities in order to take advantage of the projected interest rate changes. So aggressive, you have to forecast interest rate changes. Otherwise, it doesn't work. And if you get it wrong, you might lose a lot of money. Okay, so this is what we discussed earlier. Issues with dollar gap management: the time horizon. The gap ignores the time at which rate sensitive assets and rate sensitive liability reprice within time period, right? So if you take 0 to 3 months, your asset might reprice within 1 month, but the liability might reprice in 3 months, in 2 months, right? So the 1 month interest rate might drop, whereas the 3 month interest rate will increase. Things like that can happen. Then it doesn't work. It implicitly assumes that all rate sensitive assets and liabilities reprice on the same day, which doesn't happen. In a 30-day period, they reprice in different days. Correlation with the market: the gap assumes correlation between movements in interest rates and interest rate revenue and cost of the portfolio as 1. When interest rates increase by 10%, well, if interest rates go up, rates go up by 10%, it doesn't mean that the lending rate will go up by 10%, right? It might be a different percentage. The solution is to calculate what is called a standardized gap, which is beyond the scope. All the rate sensitive assets and liabilities will be multiplied by the correlation before calculating the gap, right? The focus in standardized gap is on net interest income. It does not consider shareholder wealth. Now, regardless of what happens to net interest income, you also have to focus on net worth or shareholder wealth, maximizing value for shareholders, which is addressed through duration gap. Duration gap is the difference between duration of a bank's assets and liabilities. Duration is the weighted average time to receive cash flows from financial instruments. Have you all heard of duration? Duration, never heard? When we were doing bonds or fixed income, we covered duration, and that was about a month ago. So by now you would have forgotten. Short-term memory loss. Right, so just make sure you revise duration and remember the concepts. The duration gap is the difference between duration of a bank's assets and liabilities. Duration is the weighted average time to receive all cash flows from financial instruments. Duration gap measures interest rate sensitivity. That helps to explain how changes in interest rate affects the market value of banks' assets and liabilities in turn its net worth. Right, so we'll do a working and see. Net worth is an indicator of solvency. Right, so net worth of a bank is of any organization is assets minus your liabilities. Change in net worth is change in assets minus change in liabilities. So this is how we calculate duration gap. It's the duration of assets minus the liabilities over assets into duration of liabilities. Duration of assets minus liabilities over assets into duration of liabilities gives duration gap. Right. Again, you can use aggressive or defensive strategies to manage a duration gap. Right. So the equation. Now these equations you all need to remember. Dollar gap and duration gap equations you need to memorize. Okay, so duration gap measures the change in net worth. Right? So net worth, remember, is your assets minus liabilities. Change in net worth is negative duration gap into change in interest rates divided by 1 plus interest rates into total assets. Right? So these equations you need to memorize. If you multiply, it's all multiplication. And there is a negative sign. Now what can you all say about interest rates? Will be positive or negative? 1 plus interest rates will be positive or negative? Interest rates are positive, so 1 plus interest rates also positive number. The total assets, positive or negative? Assets will be positive number or negative number?
Positive, right?
Positive number, right? So this is positive, here is positive and a negative. You multiply the three, positive times positive into negative, gives you a positive number or a negative number.
Negative.
Negative number. So these three combine, negative sign into positive is a negative sign. Right? So ALCO objective is what? To increase net worth or to reduce net worth?
Increase net worth.
Increase net worth. Right? And if you expect interest rates to go up, your duration gap should be positive or negative.
Positive.
No. If you put positive, then negative times positive into positive. See, minus 2 times 3 times 4 is a positive number or a negative number?
Negative number.
Negative number.
Yeah. So if you put a minus in,
Becomes positive.
then it becomes positive. Right? Yeah. So give me a second. Sorry about that. Right. So this should be positive or negative for you to have positive net worth when interest rates are moving up. Should your duration gap be a positive or a negative?
Positive.
No, negative. Right. Because this is negative, no? It's a negative number here. Right? You multiply that by a positive number, or negative times positive. Yeah, it's a positive or negative. Yeah, there is negative sign, don't forget. And so you multiply a negative sign by a positive number, it's a negative or a positive? These two?
Negative.
Negative, right? So negative into positive, again negative,
Negative.
which means this has to be negative. Right? So negative times negative is positive, times positive is positive. Objective is to increase net worth. Here is negative. You expect interest rates to drop. So your duration gap has to be positive or negative. Yeah,
Positive.
positive. Then you expect interest rates to go up. Right? You expect interest rates to go up, so you run a negative duration gap. But interest rates actually go down. It's beyond your control now. What happens to net worth? Net worth will
Negative.
negative. You expect interest rates to go down, so you run positive dollar gap, duration gap, but interest rates go up. Then your net worth will
Negative.
Negative.
be negative. Right? So what happens if you maintain a duration gap of 0? The duration gap is 0.
Net worth also 0.
Net worth? No, not that net worth is 0, but net worth will not change. Regardless of interest rate movements, whatever happens to interest rates, your net worth will not change. Isn't it? Huh? Got it?
Yes, sir.
Yeah, so that's defensive ALM, maintaining duration gap of 0. Right, so what we just explained is what is mentioned here in this table. Okay. Right, so let's try this example. On the asset side, you have cash of 100, duration 0, business loan 400, duration 1.25, mortgage loan 500, duration of 7. Right, so total assets 1000, and the duration, asset duration is 4. On the liability side, you have 1 year deposits 600, duration of 1, 5-year deposits of 300, duration of 5, and equity is 100. Right? So the total liability is 1000, duration 2.33. Calculate duration gap and change in net worth if interest rates increase by 1%. So let's try this. duration gap. Duration of assets is 4 minus liabilities over assets. At liabilities you have 900 over assets 1000 into duration of liabilities 2.33. It's 4 minus 2.1. Duration gap is 1.9 years negative, positive duration gap. Then the change in net worth is minus duration gap, change in interest rates, or 1 plus interest rates to total assets. So minus duration gap is 1.9 into change in interest rates. Interest rates increase by 1%. 1% plus divided by 1 plus. Current interest rate is 11% into total assets 1000. Interest rates go up, you're running a positive duration gap, your net worth will drop by 17.12. Do you all agree? Issues with duration gap. It assumes a parallel shift in the yield curve, right? It assumes that across all tenors, interest rate will increase by the same amount. Then it ignores convexity. You need to rebalance often, but this will be costly. Rebalancing is a costly exercise, time and cost consuming. The next way of managing assets and liabilities is through simulation. It's possible to evaluate various balance sheet strategies under differing assumptions. You can do what-if analysis and stress testing, or you can use derivatives to manage interest rate risk, right? Derivatives. Interest rate futures to hedge dollar gap. Now, easiest way to remember this section is this is a shortcut. If interest rates are dropping, you do call option on interest rates, long interest rate futures, or receive fixed, pay floating swap. And if interest rates are increasing, you can also buy long-term bonds. Okay. And if interest rates are increasing, you go put option on interest rates, then you go short interest rate futures, pay fixed, receive floating, or you sell long-term bonds. That is what you need to do. Long position in interest rate futures can be used to protect against falling interest rates. Right. So if a bank has a positive duration gap, to manage, the bank has to decrease asset duration and increase liability duration, or take a short position in interest rate futures. If they have a negative duration gap, the bank can increase asset duration and reduce liability duration, take a long position in interest rate futures. Option strategies: you buy interest rate call options to protect against falling interest rates. Bank has a positive duration gap. When interest rates fall, the reducing interest income will be offset by the gains in call options. Buying interest rate put options can be used to protect against rising interest rates. Okay. So interest rate swap, if the liability sensitive, they can go for receive floating, pay fixed. And if asset sensitive, pay floating and receive fixed. Okay, so that's what we have just summarized. I was reading off the tute. These are the relationships that you need to remember. If you understand that, you understand the rest of the slides. Okay, so that's about it in terms of ALM, right? Are there any questions? Okay, so if there are no questions, let's wind up for today. Okay, so thank you very much. Stay safe.